Alright, in this video I want to go over something that is a problem with a 401k plan that financial advisors, in my opinion, should just be screaming about. You don't hear this on financial shows, especially even on the radio. I listen to WCCO's Your Money once in a while. I've listened to several other people on YouTube. Nobody talks about this, and this really bothers me, so I'm going to make a video about this because I don't make videos on my channel that other people have already covered very well. And here's the thing. So you get your first job, for example, say you're 18, and in my case I started at a bowling alley, and I started my 401k in the beginning of 2008. Doesn't matter. You're not worried about market timing. We're just worried about long-term investing, right? I was in my 20s. I was like 23 at the time. I had plenty of time to write it out. Okay, so here's what happened. So I lost my job in 2012. The bowling alley shut down a year later, okay? So they were cutting down their losses. A bunch of other people got laid off besides me. I was not the only one. And it's not too long afterwards, I got a letter in the mail saying that you need to roll your money over. We're not going to keep this invested in stocks and bonds. We're going to put this in a money market if you don't take this money out in 6 months. Well, I put it off a little bit more than 6 months. Eventually I got it rolled over. It really wasn't that big of a deal. I don't think the market really did much between when they sold it and when I eventually rolled it over. But here's the thing, though. That was 2012. The market pretty much recovered pretty much all of its losses from early 2008. So it really wasn't that big of a deal, them selling that. But let's just say, for example, if somebody starts, so let's just say somebody got hired at the bowling alley that I worked at in 2005. Then you get, so let's just say it's in August, right? Bowling season begins probably a little bit before Labor Day in Minnesota. Mostly after Labor Day, but there's a few leagues that start before that. So August 2006, the person gets trained in, you get prepped for the bowling season, and then a year later, August 2005. August 2006, you finally become eligible for a 401k after working there for a year. Okay? And let's just say, for example, now the persons are not going to do this much. The employees are not going to do this much. Let's just take a real world example here. We're going to say this is, we're going to say actually it's zero, and let's just say they put in, they're probably only going to put in, a few days. So let's just say it's $50 a month. Okay, so you start in 2006, you end in August of 2008. All of a sudden, you get laid off. You come back to the bowling alley to work another season after being off in the summertime in Minnesota, and they tell you, well, we lost too many leagues. The economy's getting bad. Actually, this really didn't happen in 2008. Actually, where I worked, we saw a big decline beginning in 2009, and especially 2010-11, years to follow. But let's just say that this was the timing. Okay, so you lost this much return per year. Your value, is dropped. Well, I didn't put an initial investment in. Okay, now you get 6 months to roll that over. Okay, so, and here's how it works too. Typically, when you roll the money over, you're pretty much liquidating it. You're not really transferring the assets over, especially in the funds that I had through work. I don't think E-Trade or most brokers would have carried those funds, but I suppose it's possible to transfer the assets, but most people pretty much liquidate it into cash. They put it in their new IRA or 401k, and they buy a new fund, right? Okay, well, they're going to wait 6 months. So all of a sudden it's going to be like, say, February. I don't know if I'm, let's see, 4 months to the end of the year and the 2 more months. Yeah, February. So now it's February 2009. And just, okay, so now this is where it's finally going to get sold. And why is this not calculating? Alright, we'll do a reset. Wow, this is acting all strange. But you get my point. Okay, you get my point here. That the stock market kept falling. It hit a bottom in December, right, of 2008, if you look at the chart. Then it hit another bottom in March of 2009. So, if you don't have $10,000 invested in the 401k, it will allow you to keep the money invested in stocks for 6 months. After that, they sell it and they put it in a money market account. Now, if you're somebody who just forgets about it, goes to your next job, and then all of a sudden you have to wait another year, okay, to get a new 401k, because a lot of people, you know, they just follow what their employer does. They buy their health plan because, oh, that's what their employer said. That, you know, they get their HSA through their employer. You know, whatever. They usually look to see what benefits their employer provides, and they don't even look at the individual market. Now, what happens now? Okay, so now you get your new job. Say you're laid off for 6 months. You get your new job in February, and you can't get a 401k for at least a year. Now you're looking at February of 2010. Now, what did the market do? Let's just say here. Let's just pick February, and let's just pick. Hopefully this thing will work now. So we're going to go from 2009, and then we're going to go to 2010, and we're going to go February to February. Now the market gained 37%. Look at that, 37% in a year. And remember, in my hypothetical example here, it got sold in February 2009, and the fund, the 401k, started in 2006 to 2008, right? So now what you did is you sold your let me do this here really quick. So we're going to start in 2006. I'm just going to put, we don't really have, well, okay. Let's say you did $100 a month. It doesn't matter. Whatever this number is, it doesn't matter. But the bottom line here is you sold your investments, let's just say even this could even be zero, in February 2009 at a loss, and then you waited a year when the market went up 37%, and you just bought it at a higher price than what you were forced to sell at in February 2009, all because of this rule in 401ks that if you don't have, most of them will not let you stay invested if you don't have at least $10,000 invested with them. Now again, this number could be anything, 5,000, 500, whatever it is, okay? It's not a small number if you are in your 20s, or even for that matter in your teens. This is a lot of money to invest if you are young. It's not much if you're old. It's a lot of money because of compound interest. So I guess my whole point is, to financial advisors, I would be screaming about this at the top of your lungs just as much as you're saying that there's fat that people overpay for a cell phone plan they don't need, or they pay for Spotify or a vacation that they don't need to take. This, in my opinion, is the biggest blind spot in 401k investing. they need to roll the money over to an IRA immediately when they change jobs. They should not be waiting a year for their new 401k to kick in. And in this example that I'm showing here, they liquidated it. The fund, the company that runs the 401k program, could have liquidated the fund at the wrong time, and all of a sudden you're buying back in a year later because no, your new company's got a new 401k. Now you're selling low and buying high, and the employee who's contributing to the plan probably has no intention of doing so. Without even getting emotional, getting freaked out about the market, they simply just lost their job because the economy got bad. They just got screwed by selling at the wrong time, and it absolutely drives me nuts that more people do not talk about this.